Hey, everybody out there in Financial Advisor Group world, back for episode number big double digit 10 of Rapid Fire. We made it there, Ben. We made it.
Yep.
And we're both about as festive as we've gotten so far, wearing our orange for a happy Halloween. So a happy Halloween out to everyone out there. Hope everyone's fall is going okay. And we've got to remember this Saturday night-ish, Sunday morning is to turn those clocks and then it gets dark earlier. So I don't know, Ben, if you look forward to that or not, but
I
never
look
something I
forward
look
to,
forward
to
to.
to the dressing up. So it's a surprise. I can't reveal my Halloween costume,
Oh,
but
there's no disclosure yet. We don't find out
no
until Friday.
disclosure. It was a last
Okay.
minute change, so the costume hasn't been delivered yet.
Okay.
But it'll be superhero themed. So it was supposed to be
Okay.
Star Wars.
Okay.
Um,
Gotcha.
but either way, so we're at episode 10. Damien just checked right before this. We're at 91 subscribers. So our goal, now that we hit 10 videos, we'd like to hit 100 subscribers. So if you haven't
Amen.
yet, hit the subscribe button and then you'll be notified anytime we make a video. Even though we send out email blasts, you're usually the first one to see it even before the emails.
You'll give us the best Halloween treat we could ever get, right? Just click that subscribe button.
Yep. Yep.
So I
All
guess
right.
Ben, but
So
yeah, as we jump in, right? Why don't you lead us into sort of the first thing? I mean, the market's been it's a treat, right?
yeah, the market has been going up and up and up. And we always, like we say, how is it? How does it keep going up? A lot of clients ask the same question. And the answer is really like the AI story, the capital expenditure that all the companies are doing. They're trying to invest for the future. And so that, I mean, that's pretty much what's propping up the economy. There are some other, undertones. There's still great earnings expectations, things like that. But the main thing is capital expenditure. So this is the AI spend from all of the big companies, Amazon, Alphabet, Meta, Microsoft, Oracle. These are some of the top holdings for a lot of our clients as well. Um, and what you can see, this is the AI arms race. This is the amount of money that they are spending on AI related expenses. So you can see it projected. It's parabolic. So it just keeps going up. So we've talked about this a lot, but what does that actually mean? Those companies are doing all the investment, but the thing is, we'll see kind of a trickle down effect eventually. There's companies, including ourselves, that are looking to use AI. So the companies that are making all the AI products, it's kind of just like the internet. The internet came about, but then everyone else started using it and had efficiencies through their processes and their business. So just kind of queuing it up, our company is testing out some AI products. So one of the things that it can be useful is taking notes. So we're piloting a software. It's called Jump, and it basically is a transcription software. It takes notes for us, and it'll summarize. It'll put everything into a clean format. A lot of times, we're trying to be involved in conversations with clients, so it's hard to kind of do both. Take really detailed notes, so we have great information for next meeting, but also still to be connected in the meeting. So we're trying out an AI transcription software that'll help us hopefully be more involved in the meeting and have more accurate follow-up as well.
And it is amazing. I mean, I think that the question, like Ben said before, this in the title of the slide is it's an arms race. These companies just they keep competing with each other, and what they're creating, because there's a lot of people ask, well, what's the point? This jump system that we've just started testing, the efficiencies for our office could be pretty substantial. And not only do the efficiencies happen behind closed doors, but you get a more present advisor in the meeting, right? Instead of Ben or I worrying, what number did you just say? We're trying to think, yet you're still talking. It allows us to really be present in the meeting, let someone else take care of the note-taking abilities. Now we're going to check it, right? Like all AI, you got to check what's coming out of it. But it really does not only just provide efficiencies, but it lets the advisor in that room to be more present, which I think that's the thing I'm most excited about, Ben.
Yeah,
And
it's
it's
exciting.
yep.
And that's only just like the tippy top
Oh
because
yeah.
AI is new. Like there's going to be, new products, new things that are built on top of it, just like the internet. So it'll be exciting to see how it all plays out. Um, and then just to kind of go into our next point, um, the other thing. So if you remember I think it was 2 videos back, maybe 3 videos back. Damien and I played like a devil's advocate, kind of like what's helping the market. There's, AI spending that's helping it, and then there's consumer spending that's not looking too great. So just a quick update on kind of the consumer. Um, for spending, things are kind of like Tale of Two Cities thing going on. So you have very high income earners that are doing very well. You can see that's the like blue, light blue, teal-ish color. And then you have the green, which is this high income. So there you can see like still spending, still actually accelerating their spending. And then you can see lower and middle class incomes are kind of stagnant. We haven't seen a big drop off. It's just kind of in line with inflation. So kind of a long-term trend that's healthy, but nothing super concerning on that yet. But just you can see the divergence that's kind of prevalent right
And
now.
I think this gets been at sort of, as I'll use a big word, the dichotomy you sort of see happening today is that the lower income portion of the economy is definitely, we've talked about this, is showing cracks. And that's where I think a lot of people struggle to see, wait a second, we see issues, we see inflation, we see things going up in price, yet the market's still happy. Well, the reasons the market's still happy is that chart that we hear anecdotes all the time that, and I guess take a step back before the anecdote, the top 10% of income earners in this country are responsible for over 50% of the consumption in the country. Keep that in mind. So it sounds mean to say that bottom consumption, yes, it's not rising as much, but what means more to that economy is these high-end consumers keep consuming. These Mercedes G-Wagons, I don't know if any of have ever seen them, but these cars, these trucks, I guess, if you would, start at 150 to $200,000. Their sales are up 41% year over year. So again, the anecdote of wow, the bottom level feeling it, saying, man, I can't afford certain things, yet you have the top level out buying 150 to $200,000 cars. Same thing that first class flight bookings over year are up about 20%. So again, that front of the plane getting more crowded and actually some airlines adding. I think Delta actually did a whole change where they added more first class bookings. So this dichotomy, Ben, where you see that top half saying, woo, I'm buying G-Wagons. And then Ben, I know you have some information on that bottom part.
Yeah, it's just interesting. You also see not on the spending side, but also, well, I guess it's previous spending. You see
Yeah.
it in loans. Another big thing that we're looking at is the trends in prime versus subprime. So great borrowers versus not great borrowers, and the difference. 60-day delinquencies on that, meaning you haven't paid the balance within at least 60 days. Subprime delinquencies over 60-day period is at an all-time high, whereas prime is near all-time lows.
Yep.
And that's one good thing to note. Like, even though that is concerning, in 2007, 2008, where there was the whole subprime mortgage crisis, we also saw prime elevated prime delinquencies as well, which we haven't seen anything like that. So it's an interesting time. It always is.
Yeah, and I think you have again, I think I really get it when you look and more clients we talk to, if you look at the world through their eyes, you can see cracks, right? But I think we need to remember to look at the broader picture that things still in general are okay. And hence, if you have AI companies spending like crazy in the top portion of our economic sort of building spending, things are going to be okay for the market, right? Maybe not for everyone on the street, but for the market. And I think as we sort of tune down towards the end, we have a special trick or treat edition here. I guess if we finish out the slides here in our discussion on the markets, and what we'll lead in with here is from a perspective of sort of if you lead with a trick, consumer sentiment continues to be low. We just talked about it, right? That the everyday consumer tends to be in a negative mindset. What blew my mind, Ben, is looking at we're in a fear level. Rarely do you see fear levels on the gauge, and this gauge just sort of tries to get a sense of where people are. Are they greedy and want more, or are they getting afraid? Rarely do you see fear at a time when the market's at an all-time high. It's very strange. But also when you look at consumer sentiment continues to be at almost all-time lows. So the trick is that's in general, that's not good. However, the treat, which might seem counterintuitive, is when you look at times in the past when consumer sentiment has been low, you know that the returns over the next 12 months have actually been very good. So if you look at the chart on the left, it just shows here that when the consumer sentiment is the highest, the next 12 months, the market averaged 4%. When consumer sentiment is lowest, It averages about 19, right? We're horrible at predicting what's going to happen. The magazine cover from The Economist literally was in mid-April. Since mid-April, the markets had literally one of the best 6 months runs we've ever had in history, the least volatile 6 month run we've ever had in history. And yet the cover said the age of chaos, right? So when we think the world's about to end, usually things are better. So the treat is, yes, we may not feel good, but the market's rewarding us.
Yeah, it's really interesting about the whole consumer sentiment too, because we still see, I'm not sure the exact statistics, but a couple months back was like the largest inflow from retail investors. Like they're
Yep.
everyone's scared of investing, but yet they're dumping all the money in, which I mean, I think it's also a good trend. Like people, trust long-term markets and they're, continuing to save probably in 401ks, things like that as well.
And I think, Ben, the everyday retail investor is the smartest they've ever been, right? I think they've learned a lot that, yes, you might be scared, but you still buy. I think that's one of the greatest signs we see right now, where the old trends of retail investors bailing this year when the markets have dipped, they bought in, right? So I think that's a good sign long term.
Yeah, definitely. So without further ado, I'll give you my trick or treat. So my trick, this we've covered this multiple times, but we like to bring it up in October. So this is the trick, the 3-year anniversary of that famous Bloomberg article, and it was just Bloomberg that published it, but it was I forget who like the actual polling that it was all the economists were polled, and it was 100% between them, 100% chance of recession within the next 12 months. So we're 3 years out of that, and we have not had a recession. We've definitely had some, volatility here and there, but no drop in GDP, consumer spending, that sort of thing that would follow or be present in a recessionary environment. So some people they see this and they're like, "Oh, 100% chance of recession. I'm going to sell out of everything." So this is the treat. If you were a great investor, like we hope you are, you stay invested and you've been rewarded with this treat, where the market since basically 3 years ago, when that was published, 3 years in just the stock market. I'm using the S&P 500, but even a diversified portfolio is up pretty handsomely as well. But looking at this S&P 500, you're up almost 90% since that economist call of a 100% chance of recession. So again, remember we can never forecast, short-term things. The market always has surprises, and it sure will going forward. So I'd like to, take this to stay invested, listen to your plan, all of those things, and things usually work out over a long period of time.
And I think we'd end with similar sentiment of what we said the last probably one or two videos, which is, listen, this is the time it's okay to have sort of two thoughts that, wow, things are great, right? You appreciate where you are, because this last 6 months, this last 3 years, like Ben just highlighted, have been amazing. Appreciate where you are, but then also have a realistic expectation of what may be coming. We've now gone almost a record amount of time or close to it without a 5%, even a 5% correction. So it's okay to sort of say, wow, things are great, but also understand that there might be something coming that won't be great, and that's okay. So again, I think it's okay to have that sort of dueling mindset. I wish to reference back, I wish as a Raiders fan I had some positive thing to think about them, but the Eagles at least winning. Raiders, from our predictions earlier, it isn't looking too good. Um, Anyways, as I digress, but other than that, Ben, anything else before we sort of send them out with you want to give them the happy Halloween salute?
Yeah, happy Halloween. Get dressed up, be seasonal about it, go get a mask or something and have some fun. But yeah, get some candy. We have some candy at the office if you want to stop by. But yeah, enjoy Halloween and we'll see you at Rapid Fire 11.
Yeah, wrap and remember, click that subscribe button.